Valens Research, Uniform Financial Analytics.
Eli Lilly, one of the largest pharmaceutical companies in the world. And Eli Lilly, what's really interesting when we look here is not so much a question of how profitable the company is, not so much a question of valuation, but actually a question of trend. And this is what's really significant about Eli Lilly is if you look here on an as reported basis, it looks like Eli Lilly has been in a secular improvement on their return on assets the last several years. Eli Lilly has fundamentally been able to lift its business is the narrative that you would hear. It is turning around its business consistently year over year. We're going to see earnings growth. The reality is a little different. Eli Lilly hasn't gone through a transformation. Eli Lilly did improve its business from 2016 to 2017. Since then, it's basically been the exact same business it was. It's been a 10% return on asset business every single year for the last 4 years. It was a dip in 2019. But the reality is, this company isn't going through some sort of continual transformation. And that's really important because you look at these white bars, you compare them to the orange distorted as reported metrics, and all of a sudden you can totally understand what investors are thinking. They're saying, look, Lilly is a steady turnaround story. It's improving its return on assets. It's going to revolutionize its business. We think this is interesting. What we see, though, when we see the real uniform accounting data, is we can see, no, actually, Lilly's ROA has plateaued around 10%. And on top of that, Lilly's peak ROA was 16%. What the market is pricing in right now is for Lilly to grow at about the rate it has for the last 5 to 10 years, but for return on assets to get above what its all-time historic level is. Now, if we understood something deeper about Lilly, which again, we have no opinion on Lilly, but if we understood this and we actually said, you know what, we understand what was going on here. They had new drugs come out, they cleaned up their business, and they're probably where they are right now. Well, all of a sudden, if we think that this company's return on assets is 10% in the future, not 18%, wow, this is a company that could be half as high as it is right now. If we think that it's going to actually just get back up to what its historic peaks were, but then it's going to sustain those levels in perpetuity, we do buy into the turnaround. This company is still at these levels slightly overvalued. Right? But the great thing about this is all of a sudden we can understand what to focus on. We can say, what changed? Now we know Eli isn't a secular improvement. It has been the same business for 4 years. Let's understand what happened from 2016 to 2017 and see if the company is still doing that, because everything it's done for the last 4 years hasn't really changed the business. Again, we're literally changing the way that we think about this company, that way that we have a conversation in an investment committee about this company, the way that we evaluate whether or not we want our clients to be invested in this name still, et cetera, if we're looking at the right data.
Valens Research, the world's leading source for uniform financial analytics.